Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood Holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions who support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 206. As always, joined by the three amigos, Boomer over in Halifax, Rich Diaz in Montreal, Art Wall coming together.
No progress has been made, but hopefully by next Thursday. I'm getting hangers and stuff, but no, I don't know. I'm okay. I'm a little low energy, Rich, but there's lots of stuff going on. And it's the beginning of the training. I'm just pumped for hockey season.
Montreal, are you the guy who goes to watch the training camp?
I read every single thing there is. I listen to every podcast. I know it's a bad subject. Keith is rolling his eyes. I do the same for the Abs. I'm so pumped. Who's your team?
What do you mean, who's my team?
I was asking for people who may not know.
This guy's 3 years in the podcast, doesn't know. Some friend, eh, Keith?
I don't know. I tune out every time you guys go into
it. Come on, Keith.
I'm an Avalanche guy.
I do the same thing for
49ers. No, the 49ers. You love the 49ers.
Yeah, it's cool. Hey guys, so I'm back in Canada. I do have an interesting travel story for you guys. So on the way back, Mrs. Icecap and I were up in the mountains for a while, hiking and stuff. And then to come home, we go into Zurich, the big city there to come back. So we have a hotel there for one night. Around 1 PM, we're checking into the hotel. And the lady at the front desk, she's finding the name, looking at my email and passport. You need a passport to stay in a hotel for the night, of course. And she says, "Oh, I see you're checking in a little bit early." And I'm looking at her, I'm thinking it's 1 o'clock in the afternoon. It's not that early, for a normal check-in. And she says, "Yes, sir, you are 1 year early than you should be. My reservation was for 2026.
Oh no.
That's hilarious.
Oh boy.
And what happened? Did they let you in?
Well, Mrs. Icecap gave me the look like I'm the biggest idiot on earth. And of course, which was true. So, so we had to cancel that reservation. And then, of course, the only room that's available at that point in time is like the most expensive room, in all of Switzerland.
Oh, what a shame.
I
was going to say Motel 6.
Yeah, I don't think that one exists over there. Anyway, it was a pretty good. I've never encountered that before. Usually, I'm ahead of the game on that stuff. Rich, 1 year out, I booked the reservation.
I'm surprised that she wasn't impressed. The Swiss are very, very punctual people. So
it means you're going back next year.
Yeah, that's right.
What's the room number?
I have to.
Send me the reservation confirmation.
Okay, guys. This is a great week, man. This is like one of the best weeks for the monetary world for Canada and elsewhere.
This is like Christmas morning for Keith.
Nerds.
Oh, boy. Yeah.
We had obviously the Bank of Canada this week, same day as the Fed. The two big central banks. Rich, we also had the Bank of England this week, which we've been following along very closely at on the Loonie Hour. So
implications for all Canadians here. So we'll kind of start things off with the BOC. Keith, 25 basis point rate cut as expected. Markets were pricing in over 80% odds of a 25 basis point cut. So there was really no surprise there. It was more just like, okay, like what is the language and sort of the forward guidance from Tiff Macklem with the BOC? Is there more to come? And so what was your kind of takeaway from the presser?
Well, the squirmer was squirming even more yesterday. It was, I've been watching these things now for a while, and, they should be boring. But if you know what's happening behind the scenes and why something happened or didn't happen, then it's a good bit of fun. And yesterday, they cut by 25, which everyone in the world except the biggest bank in Canada was expecting, apparently. We have to talk about that later. How did they get that one wrong? But basically they wanted to get out of that meeting as fast as possible. They didn't want any conversations around anything except for tariffs. Tariffs are the number one reason for everything bad in Canada from an economic and social perspective. And man, they're in a hurry to go, and which is quite interesting, right? Because there's a lot more happening with the Canadian economy. And the biggest one that we'll get into, I'm going through my notes here for this one because it was so great. So in the cut by 25, but overall, inflation, Rich, is it getting close to their target?
No.
Okay. So inflation is still sticky. If anything, it's going higher. They also said there is no recession coming whatsoever. We have an awesome economy, maybe a bit slower, but no recession. And then they refused to talk about the potential effects of a deficit. They had maybe 4 or 5 questions about the budget that's coming up now. And maybe, I think it's 7 weeks is coming out, which we'll talk about. So a combination of inflation not going down to their target, and that's their only job, is to try to get inflation down. They're saying no recession. So by the way, if we have a recession, inflation will come down. So with no recession, inflation will stay sticky again. And this, I think everyone knows by now, when the budget does come out in early November, my view on what they should do with the budget. What is it, Steve?
Don't release it.
Don't release it, man. It's only bad things can happen.
Well, Keith, you did miss the best part.
What was
Bank
that?
of Canada has their next meeting, I think on October 27th or 29th. Anyways, it's next month in October. The federal budget was supposed to be released in October, and they just announced they're pushing it back to November, of course, paving the way for the BOC to do their thing prior to the announcement.
Yeah, like nothing happens in isolation. People who think that, I mean, they're probably booking a hotel room 1 year out than what they should be.
Those guys used to work together. Come on.
But my point, though, I want to think, so for the audience listening here, there has to be a methodical process to putting all this together when you're developing a policy for anything. So they cut rates because they're telling you inflation is not as bad as it used to be. But yet, as Rich has shared for a long time, inflation's sticky. I think everyone out there would agree. Prices are not coming down. They're still going up, especially in the food world. They're telling you there will be no recession. So we know, this is our world, if you have a recession, it will create a deflation. It'll cause prices to come down. So a recession is not bad if what you want to do is cause inflation to come down. And finally, they refuse to even consider the budget that's coming up. Could maybe potentially have an impact on the one thing that they're been empowered with, protect. So if we have a enormous deficit coming out, and we're going to have a lot of interesting conversations about it as we get closer to it. If we get a bigger deficit or the same as last year, which is probably going to be bigger than was expected, Rich, is that going to cause inflation to go higher or weaker?
Inflation. I mean, a huge budget deficit will be inflationary for sure.
Yeah, absolutely. So none of this lines up with a reason for the Bank of Canada to cut rates. However, three of us, by the way, no one's eating a Twinkie today.
Nope.
This is the first time we've all been right.
Yeah, it wasn't as what's not
Or
as
wrong.
interesting. When
They've
we
all been
agree.
shipped over to RBC.
Yeah.
They're unloading the pallet right now.
Yeah.
Oh boy, yeah, it's a lot there. But that was the first observation that came out. Like I was watching, I'm just thinking, boy, like they have no interest in any interesting conversation, with the question. We'll go into a few more. There's another one that really stood out as well. But that was the initial thing. It was expected.
Just for context there, for people that weren't paying attention to the RBC stuff. So RBC, I think was last week, put out a note saying that they were not expecting the BOC to cut. So I think they were the only major bank in Canada that basically said like no cut, which is kind of odd because again, market pricing was at like 80 or 90% at the time. So
yeah,
pretty unusual for Canada's largest bank to do that. I don't know what's going on there. But post announcement, they are now saying that they are expecting future cuts. So now RBC is saying, okay, we changed our mind. They did cut, and we now expect another cut this year.
I mean, people get stuff wrong all the time. We certainly have, and we will again. But it was just weird. This one was a weird one. Like, why? It
was kind of a layup.
Yeah, that's what I'm saying. That's what I mean. Like, it's fine to get things wrong at sort of the end of the cycle or at the beginning of the cycle because you don't know when they will, begin to cut or end the cycle. You know what I mean? But when it's 90, I mean, I think at one point it was like 95 or 96%. It went down towards the end, as we got closer to the meeting. It's just a weird one. But I mean, so my view, just quickly, guys, I just think, I've gone on and on about how I think negative real interest rates are stupid. We are now again in that position. What does that mean? It means policy is now below the rate of core inflation. I've used sort of an average of the three preferred measures just to give some nuance to Keith's point about inflation no longer being sticky. I mean, they did say that the momentum has slowed. Okay, so but what I thought was interesting was that they emphasized most of the press conference was really about growth and try to support growth and try to support the economy in that's under pressure because of tariffs and a rising unemployment rate. But I think it's important to remind everybody that the Bank of Canada is a single mandate central bank. In 2021, there was a tweak to the mandate to allow for a little bit more consideration of the employment and labor market and economic growth more generally. It's still, I would argue, a strict single mandate bank, unlike
single
the
mandate
US.
In air quotes.
Yeah.
Come on.
So like the US has two, which is full employment and stable inflation. Canada's is inflation, and we're going to talk about change in the Bank of Canada's website, I think, in a minute. But I think it's to me what they're doing is basically they're basically providing air cover for a government that cannot or will not run a balanced budget, that will almost certainly issue debt at the front end of the yield curve, something we've talked about a lot. And in my view, it was a mistake, but it doesn't matter what my view is. We sort of all knew what was going to happen, and it sort of happened as we expected.
Well, there you go. What's funny, I just noticed like from RBC now is talking about, just looking at the monetary policy, Rich, as you mentioned, that we're now going into, I guess we're now at what, negative real interest rates effectively.
Yeah, we are.
I mean, depending on how you want to sort of measure it, but
of course,
with call it, their preferred measures, their preferred measures of core inflation around 3%. I did find this comment from RBC rather interesting, which is to say that they talk about, now we're expecting a cut, but they say finally, housing activity has been in recovery mode since taking a plunge in the spring. Resale activity in August reached the highest level this year. That, however, has not yet spurred a turnaround in house prices, which have continued to fall alongside shelter inflation, and is giving the Bank of Canada cover to opt for additional rate cuts if necessary. Still, house prices are one area that deserves close attention for what could impede future rate cuts. So again, I find that rather interesting that RBC, effectively what they're telling you is that they believe there's a rebound in housing happening, and that if house prices start going back up, that will push shelter inflation back up and put the BOC back on pause, which I don't agree with. I mean, we can talk about housing and the latest stats that came out from Korea a few days ago, but I don't know if you guys had any initial thoughts on that.
I mean, I keep going back to the meeting yesterday. If everything was blamed on tariffs, there was no discussion about the fiscal position of Canada or other countries. You can't just focus on your own domestic economy, because we do not operate in a vacuum. I mean, everything is going to, what's happening outside of Canada will affect Canada as well. And I think we know that the Germans are losing a load of jobs this year. Their economy is getting hollowed out, and we know that the Brits are having challenges as well, of course. We know the American, apparently zero private sector jobs were created in the US for the previous 4 years almost. And now they're really struggling on that side. But for the Bank of Canada not to explicitly come out with those conversations, they didn't mention housing at all, Steve. That wasn't in there. They did not mention population growth.
That's not true. They did. He mentioned
at
it
the
once.
end. They did.
Yeah.
No, it was because of a question. The question was that was a question. If the question was not asked, they weren't going to. Again, like, you have to understand what's happening here. So again, they were trying. So again, all the data, nothing supported them to cutting yet. Three of us said they were going to cut. Market odds were, almost a guarantee they're going to cut. Yet on the surface, none of the data was supported. So we all know, including the Bank of Canada, that something else is happening. Something else is happening internally. Well, they're frightened to death of the economy really rolling over. I mean, the job losses from last month, I think it was 40,000 plus, I think.
No, 65.5, and the month before was 40.
Okay, so that's 100,000, in a bit. How much was that for the private sector?
It was almost all for the private sector, of course, because no, I'm joking. It was mostly private sector. It was 50K.
And like that would, if three of us, if we were the central bank, that would scare the crap out of us. Would say,
but that's not their job. But it's not their job.
Well, they funny, cut rates because of it. Like that's what they did. But that's my point, though. Something else is coming. We also talk about this trend all the time. What path or Journey or Aerosmith or Oasis. Whatever path you're going on. But economic conditions continue to grind lower or deteriorate. And the other interesting thing here, and I just love the little nuances here. So the Canadians cut interest rates. The Americans cut interest rates. Everyone is cutting in that camp. Yeah. Yet they maintained QT. So a QE, quantitative easing, that's when they're trying to push liquidity into the system. And they do that by indirectly buying in the US, buying US Treasury bills and notes that are issued by government. In Canada, they're buying federal government debt that's issued and then it's stored on the balance sheet of the central bank and so forth. The QT is the opposite. They're releasing it. They're releasing those Treasury bills and federal government bonds back into the system. And that's tightening because it's taking liquidity back out. So the question is, if you're trying to increase liquidity or make financial conditions easier by cutting rates, then why are they also doing QT at the same time? Like, no one would do that. You would say, well, no, we got to do QE again.
What are they doing?
Well, that's not strictly fair. I mean, they can't just go from.
Oh, you have to, Rich. You have to be consistent. You can't you can't be driving a truck and have the gas pedal metal and the brake on at the same time, right?
I don't agree with that at all. But anyway, keep going.
You're wrong, Richard Diaz.
Fire him.
You're out of here. But let me just finish though with this observation. I think a lot of people are following the repo market, and that's how banks square their books at the end of every day. If you're in a debit position, you have to borrow money from someone. And when you borrow, see if you're in that world, when people borrow, you need collateral. That's what the banks look for. And the only collateral that's accepted are T-bills or Treasury bills, Treasury notes, and federal government bonds in Canada. So by doing QE, there's less good collateral available in the system. By doing QT, there's more collateral.
It's the other way around. The other way around. Sorry, but anyway, I think you messed up.
And maybe, but doing QT, you're sorry. Yes.
So say it again. Say it again. Sorry, just to be crystal clear.
So when you're doing QE, people think you're providing liquidity to the system. You are, but you're taking collateral out of the system.
Okay, there you go.
By doing QT, they're putting collateral in, but liquidity is coming out. You got that opposite thing taking place. So my point continues
I am
to
very
be,
confused now.
I know. My point, though, just remember this: they're cutting rates to make it easier for the economy to get better, and they're doing QT to provide more collateral into the banking system at the exact same time. So that tells you there's something serious going on here in the system.
Rich, do you disagree?
Well, no, I mean, I'm now totally muddled up with which way is which. But I mean, I was just saying that, I mean, my point is they need to shrink the size of their balance sheet, and they have been for a long time. And I think that's to me, that's just part of normalizing what I thought was crazy, which is them printing as much money as they did.
Maintain some credibility.
Yeah, I think that was it. I think that's why you need to be able. I think the idea that you're doing both of them at the same time, to me, is not
They're shrinking it so they can expand it again.
I mean, so that's, I mean, and so to that point, just quickly, I mean, what we saw today, maybe we're jumping around a bit, but the Bank of England didn't cut rates because they cut last time, even though inflation is 3.8%. But they did announce that quantitative tightening is slowing in the UK. So it's your point, Steve.
We'll get there. We'll
get
there.
But anyway, just one more thing on the Bank of Canada. What I think is interesting is, best laid plans, right, of mice and men, which is my ice cap Canadian is suggesting that inflation is going to rise further, and that's a function of the fact that Canada imports capital goods and consumer goods. Right, we sell oil to import those other consumer and capital goods. Our currency is falling. So, everybody's focused on the DXY, or the US dollar index, and that basically going against the United States. But in Canada, the Canadian currency continues to fall against the British pound, the Swiss franc, Japanese yen, euro, and the US dollar. And where do we get all these goods? So there's a situation where there's always trade-offs, and this idea that cutting interest rates, providing super easy monetary policy has no trade-offs, that there's no sort of that it's benign, is wrong. And I think that's the game that these guys are playing, and I think it's a dangerous one. But anyway, sorry.
Well, I can tell you what won't spur inflation, despite RBC's concern, is housing. Had tons of media requests asking about, my thoughts on 25 basis point cut. What does it mean for real estate? Is the market going to take off? And like, guys, it's 125 basis point cut. So just for clarity, this has changed your variable rate mortgage. So, prime rate will effectively change 25 basis points. So a variable rate mortgage will most variables today will be about 4% now, which is right in line with where your fixed rates are, right? And keep in mind, about 75% of the market goes fixed rate. So there's really no change. After that BOC rate cut, there was no change in new purchasing power for the vast majority of Canadian borrowers, because again, that's done through what's happening in the bond market on the fixed rate side. So, and Rich has obviously flagged, hey, listen, if the BOC continues to cut and inflation remains sticky or goes up, then you could see a scenario where bond yields actually move higher as a result, which is kind of what we've seen, of course, in the UK. So, we looked at the national housing data. We got more of that. People keep talking about like rising home sales month over month. And again, this really should not be a surprise. They completely collapsed at the onset of the tariff announcements back in the spring. You're seeing a return of home buyers, albeit off of very low levels, but yet new listings continue to run very, very high. So new listings jumped 2.6% month over month in August. They're up 8.2% from last year, the second highest August on record, next to only 2020. So there is a lot of new listings, and we still have a plethora of inventory on the resale market which doesn't include all of the unsold units that are sitting on developer balance sheets, desperately trying to be unloaded through creative incentives. So I still think through the back half of this year, not a whole lot's going to change. Now, I think it becomes an interesting conversation, which we can, get into, was depending on how many rate cuts you get. I mean, if you have 2 or 3 more cuts and you have a variable rate mortgage in the low 3s next spring, I mean, that could be a different conversation. And of course, Keith, I think you'll probably argue that, unemployment would probably be a lot worse in that scenario, but
just one thing just to add on to your point about the mortgage rates. I think a lot of people will see the rate cut on the day and expect there to be a change in, let's say, the 5-year bond market, which is what mortgages are priced off of. But people need to realize that, it's a very situation is you buy the rumor and you sell the fact. And so the peak in that 5-year bond yield recently was like mid-July. And from mid-July to basically yesterday, the 5-year bond yield has been coming down. And on the news of the announcement, it's interesting how it's gone up. And if I'm right about inflation, and if people get really worried about this budget deficit, you could see a situation where that might be the bottom. I just called the bottom. But I'm just saying, like, often.
Plus, you mentioned the deficit. You're not allowed to mention the deficit.
That's right. I just want people to understand, like, you want to be paying attention to the expectations and how those change rather than the actual data point when the Bank of Canada comes out and says a thing. That's what I was trying to get.
I still think we should see modestly lower fixed rates, but I just think that, every seller's been, as Keith would say, crossing their fingers and holding their breath, hoping for, the BOC to save housing. And I think that, I don't think that saving is imminent. I still think there's a lot of troubles that are working their way through the system. And unfortunately, I think a lot more layoffs coming in the construction sector, of course, which the federal government, Rich, is going to try to offset through this massive deficit. Of course, they announced Build Canada Home.
Yeah, that's
Build Canada Homes, which just, by the way, it's a $13 billion package. It's an agency. They basically have created a new agency similar to CMHC that is going to effectively build social housing. And so this housing is not going to be built for sale. It's not like you and I can go out and buy the housing. It's just going to be government created social housing. It's going to be sort of like affordable or lower income type housing, which is not necessarily a bad thing, but it's certainly not going to help young people buy a home. And I'm skeptical that $13 billion will be allocated.
Well, unless the young people are jobless with no.
Then you can get a cheap.
Then you're going to have a house built by the government. You put it that way. But what's interesting, because you just mentioned, everyone in the real estate world, like everyone's like, man, lower rates. We need lower rates. We need lower rates. Everyone in Ottawa involved with this budget and who are issuing debt, not the ones who want to spend the money, but those who are saying, okay, we need money for this. They're like, please, 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 we need lower rates. The Americans at Treasury, they're also saying, please, we need lower rates. Everyone, again, we are, we were talking about the race to zero, a few months back, and we had a pause with it. That's what it was. Now we've resumed. We're going that direction again. And it's going to be really interesting to see how countries and governments are, where they are borrowing on the yield curve. Are they putting most of it short term? Or are they spreading it out a bit more? And, I think we're going to go through this really weird experience where even though the economy is grinding lower, and I think we are having a recession, I think the Bank of Canada are 1% wrong with this. We've already been in a recession.
Do central banks, again, historically, to my recollection, never forecast recessions?
No, they can't.
I think, I know there is someone.
They can't.
You know who else who's never forecast a recession?
RBC. Sorry.
I might get the name of this wrong, but it's the Professional Association of
Economic Forecasters.
So it's an American-based, group. So a whole bunch of people that look like Rich, basically.
Oh,
Very handsome and beautiful people. That's what I mean by that. But that group was started, I think it's in 69 or 70. Collectively, as a group, there are individuals who have forecast recessions, but collectively, this consensus number that they've come out with, they not only have they missed recessions every single time, but they never forecast a recession as happening. So it goes back, and you go to the central bank, they have their own internal people that look like Rich, of course. But they're not going to come out as well. I mean, you're right. They're not going to come out and say, "Hey, we see a recession coming." But again, they will at some point very soon. They're going to say, "Yeah, we kind of missed that one. We didn't anticipate this, and this from happening." But again, this has to be their number one concern right now. And the only reason they're cutting rates is because they're concerned about growth. They're concerned about loan portfolios, and they know Ottawa is going to come out with a what's the correct word here? What's a gazillion dollars in new debt. It's a bazooka coming up, guys. And just as the Fed is lowering rates, and everyone else, so think about the whole financing world is going to be sitting on the front end of the curve. And then you're going to have QE out everywhere to try to flatten the rest of the curve. And it's going to force liquid and mobile capital elsewhere. And see, I know you've talked about that before as well, Steve.
Yeah.
And I just think we're headed for this amazing transition. It doesn't mean everything goes to zero and everything's not going to go to the moon either. But there's going to be some complete opposite market reactions to events coming up that the big banks won't be warning everyone about it. That's for sure, especially if they missed the biggest guaranteed rate cut for the year.
Something's fishy. Something's going on there.
All right,
sounds
so
very bullish for
I smell something.
Sorry. Just quickly, while I was quietly sitting here clicking away here, what's available for everybody, by the way, is the amount of debt that's issued, and also the amount of debt that's issued for the Canadian government at different maturities. And the way they do it is they have less than 3 years, which I consider short term. You have different tranches. You have like a 1 year. You have unmatured, which is like almost like a loan instrument, very, very short. You have 3 years. You got 3 to 5. You got 5 to 10. And you've got over 10 years. And what we see, and the data is up to August, and you can see that almost 50% of all the debt that's been issued is on the long end of the curve, which really shocks to me. Oh, sorry. The other way around, excuse me, which is 3 to 5 years, which is, I guess you could say it's medium. That's not quite long end of the curve. So that's interesting. So the amount of debt since January of this year, there's been about 100 billion that's been issued, and about, let's say, 47% of it. So about 40% of it is in that medium place. So that means that interest, Keith, it's what you've talked about for ages, which is the interest payments are going to go up because they can't, because the interests are higher.
Hey guys, sorry to interrupt the show. I want to let you know, a special announcement, October 21st, the Loonie Hour is coming to Vancouver. We'll be co-hosting an event with the Canadian Real Estate Investor Podcast. We'll be doing a panel on the state of the housing market, followed by a live Loonie Hour podcast on Tuesday, October 21st in Vancouver at UBC Robson Square downtown. There's an Eventbrite link in the show notes where you can grab your tickets to that event. Come hang out with the Loonie Hour, come have a drink, socialize, meet and greet, followed by a housing panel and a live podcast. Really looking forward to meeting all of you October 21st in Vancouver.
What's interesting is the weighted average maturity of U.S. government debt extended from 4 years to 5 years. From 2022. So kind of like all this debt effectively is being rolled over effectively in this like 5-year cycle.
Yeah. So I shared the chart with Keith a couple of weeks ago. It's something like 30%. I know for Canada it's about 30%. So Canada the federal government has 1.4 roughly $1 trillion of debt outstanding. and something like 504 or 502 of that needs to be rolled over in the next 18 months, basically.
But this is like all these like governments and central banks are effectively facing the same thing, which is just like a refinance game, right? They have to sort of like grease the wheels of the system, create enough liquidity, get rates down so the debt can be sort of rolled over and refinanced for the next sort of cycle effectively. And so I think it's all playing on this. Is maybe segues into the Fed, Keith, which they were on deck, largely expected to again cut rates. They cut rates on the same day the BOC did. So at least from a currency perspective, Rich, probably giving the Bank of Canada a little bit of air cover, right? I mean, I don't think the BOC can move a whole lot without the Fed helping them out. So the Fed cut 25. Keith, what was your takeaway there?
Yeah, it was about the same. Just one other comment, though, Steve, just to finish up. The Canadian government has all this. We have this debt to roll over, new debt. For people listening, it's probably similar with your own mortgage. You know exactly when it's maturing, and you're there hoping, wishing, and whatever else you want to do to try to. You want to have a lower rate. If you have a lower rate, it means you have a little bit more money in your household to buy stuff with. Right? That's what it is for. Governments are on a different perspective, sort of, but I want everyone to think of it that way. So everyone's in that same game. So for the Americans, of course, they had their meeting. They also cut by 25. And that disappointed the market, really, because the market was hoping for the 50 basis point cut. And I think people know they have one new, are you called a governor if you're on the voting board, the board of governors, right? Is that what it is for the Americans?
Yeah.
So they had a new lad on this week.
Oh yeah, this is such a good story.
Yeah. Fresh from the White House, Fresh from the White House. And I don't know the exact numbers, but apparently, it was a unanimous minus one person decision. Powell said that everyone's agreement. First of all, everyone's a unanimous on one thing, basically, that we're not cutting by 50 and we are going to cut by 25. One person wanted to cut by 50. Guess who that was? The new guy.
the White House
guy. Is that Stephen Moran, right?
I don't know his name. I didn't follow it that closely. Right. But again, you think about it. So the White House, that's where their Treasury reports into them and all that stuff. They want lower rates. So it's the same story that's happening. But one thing that Powell said, and I think this is what's tied into the Canadian decision as well, because the question was, hey, like you all year long, you said you don't need to cut rates. You're quite comfortable where it is because the economy is strong. And the report said, what has changed? And Powell said, well, the job market has changed. There's been a lot of revisions. The economy is not as strong as we initially thought it was. So we're not changing our mind or view or process of doing this. We just have new data, and the data is now telling us that, there's about 1 million less jobs in the country than we were initially told. So that's giving us reason now to be concerned, and that's why we're cutting. He also said, what was his word? The 25 basis point is a risk management cut. So today on your social medias, you might see risk management and stuff. And what the heck does that mean? It just means they're taking a precautionary cut just in case. And really, if you think about the Bank of Canada cut, same thing, because the data is not really there to support it, just in case it hits the fan. So again, everyone has become aligned with, where we're headed.
Rich, how many cuts are priced in for the Fed? What are the market expectations coming up for
actually
Fed cuts?
Got it here for once in my life. So the next meeting is October 29th, and there is a 42.8% probability of a cut.
But isn't there a couple cuts that are priced in?
Yeah. So
the
the problem. So I think that they're basically two more and done is what's priced in, because if you look at the yield, if you look at the OIS curve, which is the overnight index swap curve that basically people can use to bet on the direction of interest rates, and effectively you extrapolate a probability distribution from that. you basically have a situation where you're one more cut and then you're basically flat, maybe like another half cut. So that's what it is right now. I'm happy to share the chart.
Hey,
So
so
the
there's
four,
a
yeah. So, but the four big guys have 2 meetings left each.
Yeah.
Yeah. So,
Okay.
so the Americans, Canadians, and the fluffy Europeans, they're meeting October 29th, all on the same day.
Again?
Cool.
Yeah, all the same day. And
Crazy.
they do. The Brits do not meet in October. Theirs is the first week in November.
Remember the 5th of November.
Huh?
What the hell is
You
that?
never seen the movie V for Vendetta? Come on.
Jeez.
It's a great
No,
movie.
I don't know that one.
Oh, Keith, you would love it. You love it.
Is there a British
Hey,
accent
so-
for that one?
Yeah.
Oh, and then they all meet in December. So my point is that everyone has 2 meetings left for the rest of the year. So for anyone to cut 75 basis points, it means they're doing a double in one of those meetings.
Yeah.
So then it comes back to, as of right now, the answer is no, they're not doing that. However, if there is some kind of event after, the Loonie Hour today, up until then yeah, they could do it. But anyone expecting any of the central banks to cut by more than 50 basis points rest of the year, it means something really bad has to happen for that to take place. Yes.
You'll like this one. So the Fed, they put out these dot plots, right? So basically it's all the members of the Fed there, they effectively put out like their forecasts and they put them on like this dot plot chart thing. Anyways, so there's an interesting observation from Bloomberg through this, basically saying yesterday's meeting was a mess when you really like look and unpack these dot plots to get an idea of where everybody on the board is thinking interest rates should go. So one member of the FOMC thinks the Fed is going to hike rates this year. One member, Stephen Moran, who's Trump's guy, thinks it's going to cut 1.25% this year. So there's 5 cuts over the next 2 meetings priced in from Trump's guy. And to see the spread of the dots above, so the FOMC is basically showing little to no agreement on what they should do, yet it was an 11-1 vote. So they're saying the rigging of the voting is basically to create the illusion of consensus. But there doesn't appear to be any real consensus when you actually look at their dot plots. Again, I found that pretty interesting.
Yeah. Okay. So in defense of the Federal Reserve, they can never. It's always like that. Like every central bank, I've been watching central banks for 15 years. Like whether it's Mario Draghi, whether during the height of the European investment bond crisis, whether it's the Bank of England, it's always like 9-1, 11-1 in favor of a thing, and the outlier is always doing more of the thing they already agree with. And that's true across everyone. But I'm looking at the Fed dot plots right now. Steven, you're right. That's actually really funny. There's only, 8 or 9 of them in the middle. And then there's, 6 or 7 on one side. And then below that is the one guy. But when
does Doug Ford get to appoint his guy at the BOC?
But what's interesting though, it's, for, 2 of those scenarios that you pointed out, Steve, like hiking rates or cutting by 125, maybe they happen. However, if they do happen, something really aggressive has happened with the global economy.
Yeah.
That's it. And so these tail events, that's what we're talking about. They're low probability events. They're not a 0% probability events. But like, for example, you go back to the 08, the housing market crisis, whatever people call it these days for the Americans. I think now people realize that there were a lot of participants were concerned with that risk, but people didn't really have the exact precise moment when it was going to happen. And then, of course, after it happens, it becomes incredibly obvious that, yeah, of course it happened. But that's sort of maybe that's where we're going now. It does, like, we are going to something like that. And again, my view, I continue to believe we're going to have a very stressful moment in the bond market. And after it happens, we're all going to say, yeah, it was pretty obvious, Loonie Hour got it right again. Maybe that's 5 years from now, right? Or 2 years. We don't know. But you got to look at the scenario coming up. But investors you should never become complacent and lose linear thinking. So because this has been a good year for different parts of the financial world, you can't extrapolate that, start bootstrapping it. It's going to take place next year, the year after.
Keith, I'm kind of wondering how you thinking through markets right now. There was an interesting note out from JP Morgan saying that the Fed cutting rates when markets are within 1% of all-time highs produces an average return of 15% over the next 12 months with a 100% hit rate.
100% hit rate?
I don't know. It's what JP Morgan's saying. I'm just the messenger here.
I'd like to see a bit more what else is happening. However,
JP Morgan trying to sell their book here or what?
Yes.
But the observation of, hey, cutting rates when equity markets are at all-time highs. And the reason that's, a bit of, mental gymnastics for some people, because some people believe the stock market is predicting forward profits and earnings. And they like to apply a valuation metrics to the stock market. Of course, we know that's all crap, of course, right, Rich? That's not the way stock markets work.
We've trained them.
Go on.
But that view, it does suggest, if you believe the stock market is forecasting that the economy is incredibly strong coming up, then yeah, it does seem really weird to be cutting rates at this part of the cycle. But they're if you look at the Canadians, they're telling you, hey, there's no recession coming up. Don't be worried about the budget. Don't be worried about things like that. I just think we are in this sort of awkward moment where something is going to materialize, and the biggest trigger point is in the job market. Because remember, everyone, if you're working every 2 weeks or once a month, whatever your pay cycle is, you're getting 2, 3, or 4% of your comp is lopped off. Maybe it's matched by your employer, and it automatically goes into investment markets. And the program is buy these stocks, buy these bonds. As long as that flow is positive all the time, of course the markets are going to go up. It's just, demand is greater than supply. The moment that flow begins to weaken, which is what we're starting to see now, especially in Canada, that's when all of a sudden it starts to turn around. So we talked before that, these job losses. I know some people have shared emails with us to share what's happening, what they see, and they do see a lot of job losses happening. But until we see the big job loss announcement coming up, and it's the big banks are the ones to really look for, that's when okay, yeah, JP Morgan is wrong with this one, but we'll have to wait and see.
Rich, any additional thoughts there to add?
No, I'm not on the U.S. government. I think, but what's also interesting about the U.S., I just think, is that there are definitely pockets of weakness that we can't overlook. I think housing is something that is very, very bad. I mean, there's no real way to slice it. I mean, if you look at the National Home Association of Home Builders Index, that basically measures sort of appetite and confidence of the housing market. I mean, that's basically not at all-time lows, because that was in 2008 and 9, but it's basically at COVID lows, which is really incredible. We're seeing, so I just think the problem we have is that people, obviously, Keith's right in a sense, they link the economy directly to the stock market. We know that that's not necessarily true. As a silly example, most of the tech industry's revenue come from outside of the United States. And if you have the dollar falling, then those revenues obviously go up in US dollar terms. But there are clearly pockets of, in my view, extreme weakness. The other thing that I think was also important to note is that the US, much like Canada, is bifurcated with respect to asset holders and sort of quote unquote the working class. We're seeing the income of high income earners continue to rise, whereas the income of low income earners fall. It's a similar situation in Canada. If you're a working class person, you're under a lot of pressure with respect to, in my view, obviously rents maybe have slowed, but food is something we haven't talked about. I mean, meat prices are up 7.2% on the year. Who knows what the actual number is? And then, and in the United States, it's a similar thing. 10% of people own something like 90% of the assets in America. And so, yeah, the stock market is going up, and that's obviously helping people at the top feel very, very wealthy. But I think there's those big pockets of sort of negative economic sentiment in the United States. And I think it's the same thing in Canada. I think if you own housing and you own stocks, then you're happy. And if you don't, you're not. And so it's just something to keep an eye on. I think often we consider it sort of as this monolithic, when we think about an economy, we think of it in monolithic terms, but there's clearly some weakness in certain parts and then there's clearly strength in others. And so you have to be very careful, I think.
Steve, in your world, like, are you aware of any like large pots of capital, from developers or investors, and they have a list of things they're waiting to see happen before they become, a lot more positive again, to start reallocating that to the real estate world? Are you seeing that, or is everyone
Not really?
sort of
No,
retrenching?
I think it's just like full on survival mode right now. I think they're all just wondering like when the market's gonna like make a turn and they can actually like begin selling product again. I think right now it's just managing existing construction projects that are already ongoing and trying to get those finished and to mitigate any sort of damages there. And then it's just, survival mode. And I think that I still think there's a huge cleansing going on from everything that I'm hearing and seeing. It's just, it's bad. Yeah.
I mean, I think that's healthy.
But it's interesting, right? Because it's like, I think it's healthy. You need that cleansing, but it's like, listen, like when you like in the GTA, like your residential development industry is like, it's literally like extinct, like it's evaporating, like it's just they're getting completely wiped out. And so, that might be the only positive I can allocate to the Carney government with this Build Canada Homes thing, is that like maybe it takes some of those construction workers that are otherwise going to be unemployed and puts them on public sector projects. Because there is a huge sort of gaping hole of a void, basically like an air pocket where there's just people are going to be finishing construction projects with nowhere to go. And those are very skilled workers and tradespeople that you can't just retrain for a different career, right? I mean, so those are going to be skilled trades that you need when the economy kickstarts back up again at some point. You are going to need more housing again in the future, and you're going to need those people to build them. And so losing them because they have no work for 18 months is not a viable solution. We'll see.
Unless you believe in free markets. I mean, I don't know. I get it. It's hard to say that out loud, but I think it's
kind of like, obviously you want to like massage it, right? You don't want to have these massive booms and busts. The problem was we had this massive boom, right? We had this massive blow off top, this excessive speculation and, decades of buildup. And it created the massive boom, which is ultimately sowing the seeds for the bust. And I think those are a lot harder for everybody than just having, sort of more stability. But
well, I mean, that's what just drives me so crazy about the Bank of Canada, just putting so much emphasis on the tariffs. I mean, a year and a half ago, I mean, the deputy bank of governor, the lovely Carolyn Rogers, came out and said, Canada's in a productivity emergency. I mean, I don't know how much clearer you need to be about how badly run the Canadian economy has been, other than the Bank of Canada's number 2 saying, break glass. Hey, everybody, please pay attention. And so that's, I mean, I know it's a bit sour grapes from my perspective, because I think Canada needs a wholesale philosophy on what to do next. But it's just, we are dealing with the after effects of bad bad immigration policy, bad natural resource policy. I mean, not investing in our research and development, on and on and on and on it goes. And where we are facing a reckoning, and cutting interest rates by 25 basis points or 1% is not, and building 4,000 homes or all this is not going to ultimately deal with those problems, in my view. But
I mean, the challenge with that, for that speech or paper or paper, 99% of Canadians don't have a clue what it means, right? We know that.
Fair.
Yeah, it's only smart people that look like rich, they know what it means. However, you are right though. It was such an important. It's for a policy group that is really not supposed to critique the government on things. Like that was like screaming from the mountaintop about it. Uh, if it was heard in Ottawa, no one cared about it, So they just keep going on. They basically, cleaned house in Ottawa with the policymakers, and I still don't think anything is happening with it on that side. And then more important still, the media have not picked up on it. The media put more attention on other things that are unimportant compared to the Canadian economy. And no, here we are. Like, when was that? When was that paper, Rich? What was the date? Was
March
it summer?
2024. March of 2024.
Yes, we're now like a year and a half gone past it, and it's still like nothing happening with it. So therefore, you're back into a real true cycle, and it's not nice for for the audience to hear, but we do need a cleansing of this system. And but even if the Canadian economy tried to reset back in March of 24 with this as the igniter or the ignition board, it still wouldn't have been enough to do it.
That's fair.
We've been living 15 years with really no risk on the yield curve, and now it's finally happening again. The opportunity though is that the whole world is experiencing at the same time, so maybe we can get a globally coordinated solution, and they'll fix it, Rich.
Yeah, right. No, they're not. It's not going to work.
It's interesting that with all the announcements of the federal government, again, we're going to see what the budget looks like on November 4th. We've had some energy projects that have been announced. I think there's probably more coming, Rich. So we'll wait to sort of cast our judgment. But I found it was interesting. There's a very credible rumors going around that Stephen Guilbeault, friend of the show, and Jonathan Wilkinson, who said oil has peaked, apparently are going to be stepping down and leaving Parliament. That is the credible rumor that's going around. So maybe are they stepping down because they don't share the same ideological views as what Carney might be announcing in potentially future projects coming down the pipe here? Because we know there's been some commentary from Danielle Smith saying that she's had very, very productive conversations in recent weeks, despite the pipeline not making the official list yet. So I'm cautiously optimistic is basically what I'm trying to say. And
me too.
Trying to keep sort of the politics and the political views out of
me
it.
Me too.
Yeah.
Yeah.
I think there's interest. There's more pressure. There was a public note from Enbridge out this year saying, "Build Canada now," an open letter to the Prime Minister of Canada. The national economy is moving in the wrong direction. Canadians deserve prosperity, not uncertainty. So the CEO, it's not often that will release a public letter saying the past decade of increasing policy complexity and uncertainty that led to delayed investments, lost opportunities, and a competitive disadvantage on the global energy stage.
Yeah, I mean, that's it. That's it. I mean, I had the opportunity to meet Stéphane Marion over the weekend.
National Bank, correct?
Yeah. And we're trying to twist his arm, trying to get him onto the show. So if you know him, let him know we're calling. But what was really interesting, his discussion that I had was his emphasis on manufacturing and how Canada basically, even if we want to sort of pull ourselves away from America or whatever, or for the example that he made was, if Canada wants to increase its defense spending budget and to do it, and to do that procurement sort of to buy from Canadian companies. I mean, he argues that it's a total pipe dream because of the decline in manufacturing. And so, what does that mean? It means that, it's like less than 5% of our economy compared to, let's say, Japan, that's 8, US 15, or China, that's 30. And then that hasn't always been true. And his argument was that there's way too much red tape. It's easy to dismiss. People on the center right are always complaining about overregulation, and then we say, people are, but it's factually, it's just a function that's just true. And he showed me the data about different sort of regulatory requirements, and compared to all other sectors that Canada has, manufacturing has had the biggest increase in regulatory requirements. And so we often talk, we stress the natural resources, because to me that's very, very low hanging fruit. But there are other ways that you can increase Canada's productivity, and by making manufacturing either easier and supporting those industries outside of the tariff mess, right? Because a whole whack of the tariffs don't even affect us because of the USMCA or the new NAFTA or whatever it's called. And so that was just a really, really interesting sort of perspective on how Canada can unscrew itself up.
Yeah, that letter from the CEO of Enbridge, it's very detailed. I highly encourage people to go and check that out. But yeah, I mean, effectively, they argue that we need to, significantly simplify regulations, shorten timelines for project approvals, commit to grow production, not limit it. Fiscal framework that actually attracts investment. So it's a lot.
One key word though. We talk about that a lot. You need to attract foreign investment. Like I find this.
It's like, well, Keith, it's like the ideology needs to shift, right? It's like
full stop.
That's all it is. It's just the ideology has to shift to effectively pro growth and harness your natural resources and build attract capital. You have to make it an attractive place to want to invest and spend money.
I'll always ask someone, what is your competitive advantage? No matter what you do, whatever what your profession is, or if you're a sports team, everyone doesn't play the same style of hockey or football or whatever. For Canada, our competitive advantage is, as you said, Rich, is the resource sector. That's it. Trying to be something else, we're trying to take that competitive advantage and water it down significantly with this. We're not allowed to talk about it, apparently, but the new way that's going to be a competitive advantage it is just mind-blowing. I mean, Canada can turn this around incredibly quickly. We just really need to change on how we see the world and what is important. Because it's funny, because what's very important to what a lot of Canadians are told is very important, the rest of the world does not see it as being important at all. And so we can really leverage the energy sector specifically. It would be incredibly, we have so many more growth coming in and successful opportunities. But I just see roadblocks coming up.
Not to beat a dead horse, but just to tie into that, we had a note here from Javier Blay at Bloomberg saying that recent data put out for China shows that China generated the most ever electricity burning coal in August, according to official government data. Country's National Bureau of Statistics put power output from thermal plants, nearly all of them coal-fired, at 627. What is that, Rich? TWH?
TWH? Oh, terawatt hours.
Terawatt hours, 627 terawatt hours.
Yeah, you got megawatt, gigawatt, and terawatt hours. And that's like a unit of measurement to like how, barrel of unit equivalent, like when you're trying to normalize across different energy types or energy like chemical units or whatever, like BTUs would be, the UK use British thermal units. The that data, which I think comes from the World Bank or the UN, is terawatt hours. So it's just a way of normalizing between, let's say, hydroelectricity or nuclear power plants or natural gas with coal, and so that's what they do.
So despite all the efforts in Canada, it hasn't even made a dent because of what's coming out of China. That's the bottom line with it.
We got an email from one last thing before we go. We got an email from a listener who I won't name because it's not fair, but he mentioned China's being, we make fun of the climate competitiveness basically because we think it's total bullshit. And we got an email from a very loyal listener, and we're grateful for his participation and for listening. But he sent me an article about the New York Times and how China is leading the charge on all these renewable energy. And I just think that we have to be very careful about sort of what I think is just unbridled Chinese propaganda. Because when Javier Blais, who's I think one of the best people in the world when it comes to commodities and energy, is telling you that China is continuing to do the opposite of what people like the New York Times and the Globe and Mail are telling you, I think it's worth just at least considering the perspective that most of the developing world does not give two hoots about emissions and will continue to exploit the easiest, most cost-effective, and arguably the least efficient form of energy, and that is coal. And so I'm not saying Canada should produce coal. I've said it for years. We should really double down on nuclear power. But just, you know, I would just say just be a little bit dubious of the New York Times.
Yeah, so if we actually you can unpack his charts there a little bit further, but it says, so China, so again, China derived 627 terawatt hours from coal. And they,
it's about 60% of their total energy.
Yeah, so 627 terawatts from coal. And then on solar power, they generated 53 terawatt hours.
It's there's no one's doubting the amount of money being spent in renewable energy. I just think people misunderstand the share of energy versus the absolute number and where that's going, why it's going up, and more importantly, you know, whether the rhetoric aligns with reality. And I'm just saying the reality is very clear. People are consuming way more fossil fuels, and that number is going up. People are also consuming more renewables, which is also going up.
Well, Rich, we also had speaking of that before we wrap up, there was also a very good article this week from the IEA, was there not?
Oh, yes. Amazing. Thank you
so
much.
We do give the IEA a very difficult time because I think they've been calling sort of the peak for oil demand for a decade plus now. And every year they've been wrong, and they've come out and made revisions and pushed it out. And so we'll give us the update from the IEA.
Well, I mean, so again, Javier Blais is the one who sort of highlighted this, and he's a brilliant follow on Twitter. I've read his book. You know, he writes brilliant stuff for Bloomberg, and I really highly recommend that you sort of just check it out. And so, yeah, so I mean, and the IEA is known for being like ideologically captured, right? That they want fossil fuel consumption to end. And so as a function of that, all their forecasts show like a collapse in fossil fuels like over the next, let's say, 25 years. And then, of course, every year fossil fuel consumption goes up, and then they show another forecast showing it collapsing in the next 20 years. And I mean, it's not, and I think I don't know, they had a moment of clarity, or maybe somebody got fired and replaced, who knows. But what this chart is showing is that actually for the first time in a long time, I think that they've really sort of capitulated and shown that fossil fuel consumption will continue to rise for the next, let's say, 50 or so, 100 years. It was in the Bloomberg opinion piece, and we can share the chart.
There we go. It's a good place to wrap it up. As always, guys, appreciate the support of the show. If you have found any sort of value or entertainment out of it, all we ask is that you share it with one friend or family member. Continue to build the Loonie Hour community, and we'll see you next week.